On October 10, 2025, more than 110 million options contracts changed hands in a single day. A new record. Most people picture options as a side bet on the stock market, a casino bolted onto the real thing. That picture is backwards. On many days, the options market is the thing moving the stocks underneath it. Here is the first surprise. The options market is no longer small. Across US exchanges, traders are on track to clear more than 13.8 billion contracts in 2025, the sixth straight record year. Daily volume now averages about 59 million contracts, up roughly a fifth from the year before. And back in 2020, Goldman Sachs flagged something strange. The value of single stock options changing hands had started to rival, and on some days exceed, the value of the shares themselves. So the tail is not small anymore. The question is how a bet on a stock can reach back and move the stock itself. The answer is not gambling, it is hedging, and it is mechanical. To see it, start with a simple question. When you buy an option, who sells it to you? Usually not another small trader. It is a market maker, a dealer. Their job is to quote a price, take the other side, and earn the spread. What they do not want is a directional bet. If you buy a call, the dealer is now short that call. If the stock rises, the dealer loses, so the dealer does not sit there exposed. The dealer hedges. To cancel the risk of being short a call, the dealer buys some of the underlying stock. How much? It depends on how sensitive the option is to the stock. That sensitivity has a name. Delta. A deep-in-the-money call moves almost 1-for-1 with the stock. A far out-of-the-money call barely moves at all. So the dealer holds shares in proportion to delta. Here is the catch. Delta does not stay still. As the stock climbs toward the strike, the call becomes more sensitive. Its delta grows, so the dealer has to buy more shares to stay neutral. As the stock falls, delta shrinks and the dealer sells shares back. The dealer is not predicting anything, the dealer is just staying balanced. But staying balanced means buying as price rises and selling as price falls. Multiply that across millions of contracts, and the hedging itself starts to push the market. So what decides whether that push calms the market or sets it on fire? That rate of change has its own name. Gamma. Delta tells the dealer how many shares to hold. Gamma tells the dealer how fast that number changes as the stock moves. When gamma is high, small moves force big changes in the hedge. Now picture the most common setup. Traders and funds are buying call options. The dealers, in aggregate, are short those calls. When you are short the options you have sold, traders call that being short gamma. And short gamma hedging runs in the same direction as the move. The stock rises. Delta on those calls rises. To stay neutral, dealers buy stock. Their buying pushes the price up further, which lifts delta again, which forces more buying. It is a feedback loop. The hedge chases the move instead of fading it. The same machine runs in reverse on the way down. The stock falls. Dealers must sell to stay balanced. Their selling pushes it lower. A normal dip turns into an air pocket. Nobody at the dealer desk wants a crash. They are just staying neutral. But when the crowd is positioned this way, neutral is not calm. Neutral pours fuel on whatever the market is already doing. But it is not always like that. Sometimes dealers are long gamma. That happens when their net position means they must hedge against the move instead of with it. Long gamma dealers sell as the market rises and buy as it falls. That is mechanical mean reversion. It pins the market in place. Small moves get quietly faded. Days feel boring. So the same market has two different personalities, depending on which way dealer gamma leans. Above a certain zone, hedging dampens moves and the market self-calms. Below it, hedging amplifies moves and the market feeds on itself. Traders call the crossover the gamma flip. One important caution. The exact flip level is not printed anywhere. It is estimated from options open interest, and different analysts get different numbers. The chart on screen is a schematic, not a live reading. The point is not the precise line. The point is that the same headline can produce a gentle wobble on one day and a violent slide on another. The difference is often not the news. It is where price sits relative to all that hedging. So why does this move the whole market now, and not just a meme stock here and there? Scale. 3 things changed. First, sheer size. Index options on the S&P 500 hit a record, about 3.8 million contracts a day in the third quarter of 2025. Second, speed. More than half of that S&P options volume is now 0 days to expiry, options that are born and die the same day. About 57%. Same-day options have huge gamma, because there is no time left for anything to change except price. So the hedging they create is fast and concentrated. Third, the crowd. Retail traders are now responsible for nearly half of all daily options volume. More hands, more contracts, more hedging underneath. Put it together, a larger pile of options, much of it expiring today, with dealers hedging against all of it in real time. That is how a market for bets on stocks reaches back and steers the stocks themselves, not every day, but on more days than it used to. Here is the clearest case study the market has ever produced. GameStop, January 2021. In the middle of the month, the stock sat around $20. Then a wave of traders bought call options. Out of the money calls by the millions. On January 28th alone, traders bought roughly 1.5 million GameStop calls, against only about 78,000 puts. As the stock rose, dealers who had sold those calls had to buy shares to hedge. That buying helped drive the stock higher, which forced more hedging. The classic short gamma loop live on every screen in the world. GameStop closed near $347 on January 27th. The next morning it touched $483 intraday, from about $20 to $483 in roughly 2 weeks. Now the honest footnote. The SEC studied this episode, and its staff concluded the options data, by itself, was not enough to prove a pure gamma squeeze. A lot of the buying was hedge funds covering shorts, so gamma was one engine, not the only one. That nuance is the whole point. The mechanism is real, but it rarely acts alone. The people hurt were not the dealers. They were hedged. It was everyone who bought the story near the top. So the next time the market shrugs off terrible news or falls apart on nothing, you have a sharper question to ask. Not just what happened, but who had to hedge and in which direction. The options market does not tell you what comes next. It is a lens, not a signal. But it explains something most commentary misses. The same machine that quietly pins the market on a calm Friday can, in a different regime, turn a small push into a stampede. It is not magic. It is just a lot of people staying balanced at the same time. The question to sit with. As ever, more trading moves into options that expire the same day? Does the tail keep getting bigger than the dog? More breakdowns of the market's machinery are on the way. This channel explains how markets work. It is educational, and it is not financial advice.